the UK state pension is just £23 away from triggering a tax bill. Not £23,000, not £2,300, £23. The full new state pension in 2026 is £12,547 a year. The personal tax-free allowance is frozen at £12,570. That gap between them is just £23, which means this. If you receive the state pension and draw even £2 a month from a workplace pension, you become a basic rate taxpayer in retirement, and the gap narrows every year. The state pension rises with the triple lock: wages, inflation, or 2.5%, whichever is highest. The personal allowance is frozen until 2028. So the income you built for yourself, the money you deferred, the decades of contributions, the government is taxing it, quietly, structurally, at exactly the moment you have the least flexibility to manage it. Nobody made sure you understood that. Not your workplace, not your pension provider, not a government leaflet. Perhaps nobody was required to, but the result is the same. This video is about what most people are never clearly shown and what you can still do about it. If you are in your 50s right now, you have done the things you were supposed to do. You have worked most of your adult life. You have paid your national insurance. You have been auto-enrolled into a pension. You have seen the pension statements, maybe from 2 or 3 different employers, and the number felt like it should be enough. Something about it always seemed like it would sort itself out. You are not reckless with money. You are not irresponsible. But between raising a family and absorbing 3 rounds of energy bill increases since 2021, there has not been much room to look too closely, and there is something you have not quite let yourself say out loud yet. You are tired, not lazy tired. 40 years of work tired, and the idea of working another 10 years because you cannot afford to stop. That is not something you are prepared to accept. Not without understanding what you are dealing with, so let us understand it. Starting with 4 numbers that most people have never seen in the same place. 4 numbers, just 4, and once you see them together, you cannot unsee them. Number 1, the full new state pension in 2026 is £12,547 a year. That is £1,046 a month. Keep that in your head. Number 2, the Pensions and Lifetime Savings Association researches what retirement actually costs in Britain. Their minimum standard for a single person in 2025 is £13,400 a year. That is £1,117 a month. Not a comfortable retirement, not holidays, not a new car, the minimum, a basic functional existence. And that assumes you own your home outright, with no rent and no mortgage. The state pension gives you £1,046 a month. The minimum for a basic retirement costs £1,117 a month. That is a shortfall of £7,100 every single month from day 1 of retirement. Every year that is £852 short. Over a 20-year retirement, that is £17,040. Number 3, according to various industry surveys, the average defined contribution pension pot at retirement sits somewhere between £30,000 and £40,000. Think about that. After a lifetime of working, after decades of contributions, decades of saving, and the average pot sits in that range. At a 4% drawdown rate, that generates £1,480 a year, an extra £123 a month. So the state pension plus the average pension pot together gives you £1,169 a month, against a minimum retirement standard of £1,117, just above, but with almost nothing left over, no buffer, no contingency, 1 boiler failure away from crisis. Number 4. Roughly, 2 in 5 people approaching retirement in Britain say the state pension will be their main or only source of income in retirement. Not a supplement, not a top-up, the main income, 40 years of work, and £1,046 a month is the destination. Now I want to show you something most people do not find out until it is too late to change. There are 3 hidden mechanisms built into the UK retirement system. None of them are accidents. None of them are malicious. But none of them were ever explained to you clearly. Hidden mechanism 1, the 8% myth. Auto-enrolment requires a combined minimum contribution of 8%. Sounds reasonable, except that 8% is not 8% of your salary. It is 8% of qualifying earnings, a band between roughly £6,240 and £50,270. If you earn £32,000 a year, you are not contributing 8% of £32,000. You are contributing 8% of about £25,760. Your effective contribution rate on total salary is closer to 6.4%, not 8%, and that is the legal floor. Many employers only do the minimum. Many employees only do the minimum. And the minimum, over 30 years, does not produce a pot that replaces anything close to your working income. Hidden mechanism 2, the sequence of returns trap. This one does not get talked about enough, and it should concern anyone with a defined contribution pension. With a defined contribution pension, the order in which investment returns happen to you matters enormously. Retire in a good market and your pot holds up. Retire in a crash, like 2008 or early 2020, and you face a different problem. If you are drawing income from a falling pot, you are forced to sell units when they are cheap. Those units can never recover. Final salary pensions were immune to this. That risk sat with your employer. Defined contribution pensions are not immune. That risk now sits with you, and nobody told you it moved. Hidden mechanism 3, the frozen threshold tax trap. We started here, but let us go deeper. The personal allowance is frozen at £12,570 until 2028. The state pension is £12,547 this year. That leaves just £23 of tax-free space. But the state pension rises every year with the triple lock. The personal allowance stays frozen. On current Treasury forecasts, the state pension is expected to exceed the personal allowance before the end of this decade. When that happens, retirees will owe income tax on the difference. The state pension itself arrives in full. MRC recoups the tax through your tax code on any other income you receive. But if the state pension is your only income, you may need to arrange payment directly with MRC. Either way, every pound above $12,570 becomes taxable at 20%. You worked, you saved, you did what you were supposed to do, and the system is quietly taxing the income you built at the moment you need it most, with the least ability to adapt. This is not a conspiracy. It is a structural outcome, and it was not in any workplace pension leaflet. Let me make all of this concrete. Let me show you what these numbers actually look like in someone's life. Margaret is 58. She lives in Nottingham. She owns her house. The mortgage comes off in 4 years. She has worked as an administrator in private healthcare for 24 years, then moved to a private GP practice 9 years ago. She earns £32,000 gross. She is a good earner for the area. She is a widow. Her husband died 6 years ago. Their retirement plans were joint. Those plans have been hers alone since then, and she has not sat down to fully recalculate what that means for her personally. She has 2 defined contribution pension pots, one from healthcare, one from the practice. She is not sure what either is invested in. The default fund, she assumes. Her combined pension pot today is £47,000. She has checked her state pension forecast. She is on track for the full amount. She plans to retire at 67. That is 9 years away. Here is the thing nobody has told Margaret. Her pension provider sends her annual statements that say she is on track, but that projection assumes she continues contributing for a further 15 to 20 years. That is past the retirement age she actually wants. She is not on track for the retirement she wants. She is on track for a retirement that will feel survivable, but tight. Her pension pot at 67, assuming current contributions and a conservative return, somewhere between £80,000 and £85,000. At a 4% drawdown rate, that generates £273 a month. State pension plus pension drawdown, total monthly income, £1,319. Against the minimum standard of £1,117 a month, she is above it by £202, with no buffer for a boiler replacement, a dental crown, a return train ticket to see her daughter in Edinburgh at Christmas. And remember, Margaret owns her home. Her mortgage will be paid off. She has 9 more years to contribute. Her situation is actually one of the better ones, and it is still tight. If Margaret were renting privately, her income would not cover rent in most UK cities. and around a third of over 60s in Britain now rent or will do. Full stop. Let me show you what retirement looks like across 3 scenarios for a single person retiring in 2026. Scenario 1, state pension only, monthly income, £1,046. Against average bills for a homeowner, just the basics. You are looking at around £1,100 a month, up to £1,300 a month. Monthly shortfall, somewhere between £54 and £254. That does not sound enormous, but it compounds. Over 12 months, that is between £650 and £3,050 in the red, every year, with no earned income to fill the gap. And at 70, 75, 80, the ability to go back to work decreases. Scenario 2, state pension plus an average pension pot of around £35,000. Monthly income, £1,169, just above the minimum. No buffer, no contingency. The margin disappears at the first unexpected bill. Scenario 3, state pension plus a pension pot of £150,000. The pension drawdown at 4% gives £500 a month. Total monthly income, £1,546. This is where retirement starts to look manageable, not lavish. But above the floor, with some breathing room, the question is, how do you get from a £47,000 pot today to £150,000 by 67? That is the question Margaret needs to answer, and it has an answer. Here are Margaret's 2 paths. Path A, the default. Margaret keeps contributing at current levels. She retires at 67 with a pot of around £82,000. Monthly income, £1,319. She manages, mostly. She does not go without. But she does not have much of a buffer. She does not replace her car easily. She starts watching the energy bill more carefully. In year 10 of retirement, her pension pot may be significantly lower. Markets may have been poor. Unexpected costs may have forced her to take more out. She becomes increasingly reliant on the state pension alone. At 78, Margaret is living on £1,046 a month in a cold house, hoping the boiler holds. Path B, 2 deliberate changes. Change 1. Margaret increases her pension contribution from 5% to 10% of salary. On £32,000, that is roughly £133 a month into the pension before tax relief. In real take-home cost for a basic rate taxpayer, that is about £107 a month less in her pay packet. Change 2. She consolidates her 2 pension pots into one. She reviews her investment allocation with a regulated financial advisor. She makes sure it reflects the 9 years she still has before retirement. For context only, many default pension funds are built for broad populations, not individual time horizons. A professional can assess what is appropriate for your specific situation. The projected pot at 67 on Path B, somewhere between £110,000 and £125,000. Monthly income on Path B, £1,046 state pension, plus approximately £420 drawdown. Total, £1,466 a month. That is £147 more a month than Path A. Over a 20-year retirement, the difference between Path A and Path B is roughly £35,000 in total income. That is the difference between heating the house properly and rationing it, between Edinburgh at Christmas and not going. That is not a fantasy transformation. That is not invest your coffee money and become a millionaire. That is one contribution adjustment and one phone call to her pension provider. That is the whole thing. Here is the rule I want you to take from this video. The state pension is a floor. You have to build the walls. The state pension is real. It is guaranteed. It adjusts every year. For millions of people, it is the most reliable income they will ever have. But it was never designed to stand alone. It was designed as a floor beneath a final salary scheme that your employer built above it. That scheme built the walls. Those schemes are largely gone. The floor is still there. The walls, the income above the floor that makes retirement livable rather than just survivable, those walls do not build themselves anymore. You have to build them. And the earlier you start, the cheaper each brick is. Before we finish, I want to reframe something. We talk about retirement as if it is a reward. 40 years of work, and then the reward is you stop. For people who retired under final salary schemes in a world of cheaper housing and lower energy costs, that was broadly true. You worked, you stopped, the income kept coming. That world has changed. Retirement is not a reward anymore. It is a structure you have to build. Not because you did anything wrong, not because you were reckless or irresponsible, but because the architecture of retirement in Britain shifted, quietly, over 30 years. The responsibility for building income in later life moved from employers and the state onto individuals. The floor is still there. The state pension, the national insurance system, the triple lock. That floor exists and it matters, but a floor is not a home. The people who answered the question at 55 have options. The people who answered it at 66, the year before they plan to retire, are largely answering it too late to change much. You are watching this now. That is the point. Before you close this video, I want you to do one thing. Go to gov.uk/check-state-pension. It takes about 2 minutes. You log in with your government gateway account, or create one if you do not have it yet, and you will see your actual state pension forecast based on your national insurance record right now, plus a list of any gaps in your record that you could still fill. That number, that forecast, that is where your retirement planning starts. Once you know that number, you know which scenario you are actually in. And once you know which scenario you are in, you can decide whether you are building the walls or hoping they build themselves. Drop your forecast in the comments if you are comfortable sharing it. Not for me. For the people watching who have not checked yet and need to know that real people are looking at this number. And if this video raised questions you do not know how to answer yet, the next video covers exactly that. It is about what to do with a defined contribution pension in your 50s. It is already up. Link in the description. And as a final reminder, nothing in this video is financial advice. For guidance specific to your own situation, please speak to a qualified financial advisor who is registered with the Financial Conduct Authority.